It's Asia's oldest stock exchange and also the 10th oldest in the world. It's also the 10th largest stock market and probably the 4th largest in equities, only after the US, China, Japan, and then us. So it is not a place which has come up in the last few decades. It's seen the high tide and the low. It has seen an economy which was highly regulated to what it is today. More can be done. It's also today a market where the market capitalization is about 4.3 trillion US dollars. So the BSC has been instrumental in developing many things for India, India's capital markets. I remember in 2016, sometime in around the end of December, I think, the first international exchange of India was started here. The contribution, therefore, during some of the most challenging times, which led to a lot more systematic and systemic regulatory frameworks, have all been because of the positive contribution the Bombay Stock Exchange has made. So in India today, where investment-led growth is the government's strategy, at the macro level that is, combined with an all-inclusive growth, which will have an element of welfare, more from the point of view of empowering the poor, not so much from the point of view of entitlement for any section. So you empower the poor, you give them the basic requirements, which are civic requirements, and automatically their aspirations will get served because there is access to many of the things that they would want: opportunities, skilling, education, finance, credit, and so on. So this government's route is to have an investment-led growth strategy in which policies for greater FDI flow, policies for greater openness and transparency with a lot of technology infusion, whether it is in the markets or whether it is in the institutions such as banks, technology and adapting it so that it becomes easy for common citizens to perform their daily chores. Compliance has become easy for enterprises. Transparency becomes easy for governance. And above all, functioning efficiency is improved for markets. So that is the route in which we are moving. And for that, from among the more traditional 4 factors of production, I would think 5th is the technology, but that can remain where it is. But among the factors of production, capital has always had a great emphasis, because land can remain where it is, labor can remain where it is, enterprise can be devoid of any spirit if there is no capital. And therefore, capital is from among the traditional 4 and the new 5th added, unless factors of production are all infused with capital, you're just not going to have that efficiency and production happening to the extent that we would want. And therefore, financial markets play a very, very crucial role, and for not just capital mobilization, but also for capital allocation, the seamless way in which capital flows into places from where productivity can improve is very important. And that's where markets play a very big role. And therefore, for markets to play a big role, for markets to make that critical edge difference to the growing economy, I get to talking what is important in this election atmosphere. Stability of government is the first criteria. For markets to be efficient, stability of government, stability of policy, particularly of taxation policy, and predictability in which everything comes in terms of when it is getting introduced, when it is getting executed, and above all, a soft touch regulatory framework. These are the high points with which markets become efficient, markets function without volatility. Earlier, there used to be a poverty index. Earlier, there used to be a human development index. All of them continue. But today, what is keenly watched is the VIX, volatility index of the markets. And therefore, standing in BSC, I want to very clearly lay before you that Prime Minister Modi's third term, one more very good, stable, high governance, good governance, more governance, less government is what we are looking forward to, and we are confident that Prime Minister Modi will be forming his third term where India will become the third largest economy. So for a stable, vibrant, and deep Indian financial market, the prerequisite, as I would put before you today, is to have a stable government, majority government, and a government with a visionary leadership. And that is what BJP and the NDA coalition, and today our leader, the Prime Minister, has filed his nomination to get elected for the third term. And that is what is going to make markets function with that element of stability, predictability, and a visionary leadership. So in that context, when I stand here to talk before you, I want to highlight the fact, why do we need to have vibrant financial markets? Of course, for the valuations and the investors and so on. But one critical element which normally doesn't get spoken about is vibrant financial markets are the ones who can mitigate the adverse selection problem in credit by reducing the information asymmetry. When you have information asymmetry, then the problems of very many things happen. Credit flow is affected. You're not sure where the money is coming from, where it will go, which will be the direction taken, and so on. So unless financial markets are vibrant, you're just not going to have that asymmetry mitigated. We need that to happen. And also, just as was mentioned earlier by the president who's seated here, India's financial markets have far exceeded everybody's expectations in the recent past. And therefore, all appreciations to you all for having performed, and performed with distinction at a time when global markets are all fluctuating. There's so much volatility. There's somewhat a fear of uncertainty setting in most of the markets. And even uncertainty, which is a good element for people in the markets to play with. And that's what is the, I suppose, the juice, the spirit with which markets function, even by their standards. What is prevailing today is rather too uncertain. But even in that atmosphere, Indian stock markets have performed very well, attracting both foreign and domestic investors. I think it is being aided by the fact that growth forecasts for the GDP are very positive. Inflation is being in a manageable level. Political stability at the central government level is clearly visible. And all this has contributed to a good picture of India getting painted. And that has made India the fastest growing economy Most investors who come to visit India today are keen to see where their money can be placed or parked. And that itself is a very big change. In terms of one of the things that I mentioned earlier, use of technology to make transparency or efficiency set in markets. I think the best thing which is happening in India's markets is technology has been brought in. You see business volumes going up. And that itself has been used as an indicator to rank Indian markets as some of the best in the globe. And the adoption of technology, therefore, has made a very big difference. That has obviously the fast trade instruments that you've brought in, T+2, T+1, now T0. Many of the Western markets are not able to even gulp it. They're happy with T+2, no complaints. No, but you said no, T+1 is possible. We'll do it for you, which is all right, not bad. Are we doing it in India? Now, but when T0 has come in, many of them don't even have the capacity to absorb it yet. And they are not hesitant to admit it. That is the level of efficiency with technology that you have come forward to offer, and that has brought in a great confidence and trust in the Indian markets. Combined market capitalization is something which you referred to, sir. The BSE listed firms surpassed 400 lakh crores of rupees in April 2024. 10 years ago, it was only 76 lakh crores. Numbers speak for themselves. No need for a finance minister or anybody else to come and speak your glory to you. You're showing it to the world. This is the number. This is the way in which we have remained robust. The MSCI Emerging Market Index is also something which speaks for your performance. One of the most followed indices in the world. In 2013, placed us at 6.3%, whereas it is now more than doubled to 14.6%. MSCI Index, Emerging Market. There's also this concern, mostly of the opposition, because they're used to looking at savings in the traditional instruments like post office or fixed deposit in the banks. India has prided itself about how it's a savings-driven economy. Today, that savings is still happening, but it's not just happening in post offices and in fixed deposits. It's now showing up also in retail demat accounts. Because through technology and the way in which compliance for listed companies have happened in the last several decades, people are able to see it transparently about how board-driven processes have brought in efficiency and corporate governance has improved. People are willing to put money in the stock markets because they are better informed. And as a result, where in 2013, we had only 2 crore demat accounts, retail demat accounts. Today, we have 15.1 crore demat accounts. And just in the last 1 year, 3.6 crore retail demat accounts have got added to this list. So, actually, there is such dynamic change happening in the way in which savings pool of families are no more just looking at post office savings or fixed deposit in banks or in some chit funds. They are actively coming into opening of demat accounts, believing in the performance of stock markets. That speaks volumes because Indian savings people becoming investors. You're talking about a very conservative, no harm in being conservative because it's their money, hard-earned money, but conservative savings mindset today, looking at opportunities in the stock market, understanding the risk it involves because there is trust in the way in which markets have performed, and that is a reflection on your performance. I just want to highlight that even the mutual fund industry, which 10 years ago managed assets worth only 6 lakh crores, today stands proud managing assets worth 54.1 lakh crores. Just 10 years ago, 576% growth in mutual funds who manage assets. The mutual fund asset under management has doubled in the last 4 years. If I said 10 years, that's the growth. In the last 4 years, it's doubled. 580 companies have raised more than 3 lakh crores in IPOs. Would you believe this in India? IPOs are giving you 3 lakh within the country, 3 lakh crores, and 580 companies have managed to raise it. Unique mutual fund investors has grown from 1 crore in 2014 to about 4 crores today. Mutual fund investors and average monthly mutual fund SIP contributions have grown 4.5 times in the last 7 years. Where was it in 2016-17? It was at 3,660 crores of rupees. And where is it today? 23-24. It is at 16,600 crores. Indian savings moving from fixed deposits to come into mutual funds and SIPs. Speaks volumes. Indian savings, small middle class families today realize that even if it is risk laden, they are better informed and therefore they are willing to move to this area of investing in stocks and shares. Rates and InvITs. Rates and InvITs are two fantastic instruments which our financial world has created, and today's sovereign funds are happy to come and invest in them because they see them as a very powerful instrument, transparent instrument through which they're able to invest and earn money. The growth which we've seen in the last 5 years, the combined NAV surging from last 10,000 crores where it was 5 years ago. Today it is 2.5 lakh crores. 10,000 crores to 2.5 lakh crores through REITs and InvITs. The bond markets, debt markets have also come a long way. The corporate bond market size, that is outstanding amounts, growing by about 30% in the last 3 years. In the last 3 years. Where was it in September 2020? It was at 34 lakh crores. And where is it today? 45.5 lakh crores as of December 2023. So that is in spite of some parts of the world seeing high inflation. And in India, although we kept it largely within the manageable, accommodative level, they still had speculations about what will happen because of inflation. But still, this one area has grown 30% in the last 3 years alone. So this persistent flow of domestic savings towards the stock market has actually played one very important role. They have become now the counterbalancing force when FPIs come and go. So there may not be actually any fluctuation despite the whimsical FPI movements, Indian owned savings which are coming from small retail investors is providing the shock absorber for you. But what a drastic change in our investment financial market scenario. Can this be India? It is. Data shows. But that mindset that India's savings will have to be small savings in post offices and banks alone has not gone away from the minds of our opposition parties. But India has moved far away, moved far ahead, and moved fast forward. That's what I want to highlight here is reflective of the market's performance, stock market's performance, and the trust that they have in today's market's governance structures. It's a very precious value. It's a precious trust which Indians have got in the stock markets. It's very, very precious for all of us to guard and build from strength to strength. The introduction of online KYC rules during the COVID time by SEBI was the trigger. From then started this flood. So the Indians were waiting. Look, I have money, I'm putting it at 3%, 2%, or 5% at best. Is there no other way in which I can? COVID and the online KYC really opened the floodgates, if I can use that expression. Of course, now the JP Morgan and the Bloomberg are all going to be literally bringing funds into India. JP Morgan alone, that inclusion into the JP Morgan index alone is expected to bring at least 20 billion US dollars into India. Enormous potential. Just the BSC. I would appeal to this BSC that you should work closely with the SEBI in order to ensure stringent compliances and robust regulatory standards so that further investors' confidence grows. You are doing it. I take this opportunity to appeal because I have this captive audience in BSC itself. I appeal to you that you work closely with the SEBI. Any unchecked explosion in retail trading of futures and options can create future challenges, not just for the markets, for the investor sentiment, and also for household finances. Household finances have made a generational shift, which I just explained. We want to safeguard that. We want to ensure that that's not going to be shattered. We need to have both the BSE and NSE ensuring market stability, mitigating systemic risks, and making sure that the stock exchanges therefore will leverage technology and adopt blockchain and AI and have big data also to improve market efficiency and transparency and security. Fintech companies are coming up with a whole lot of instruments. We need to have trading more efficient and user-friendly. Adopting technology can help us in that. And I see that the BSE can play a proactive role in promoting high standards of corporate governance, even among listed companies. You can engage with them, talk to them, and make sure that the investor confidence is kept up. So even as the industry is moving towards adopting 4.0, Industrial Revolution 4.0, I think it is important for stock markets also to look at it. Many countries and big economies and big companies are all heavily investing in R&D. We need to have that kind of a approach for developing the software so required. I'd like to quote here the McKinsey Global Institute prediction that Finance 4.0, being a subset of Industrial Revolution 4.0, will help growing and emerging market economies by over 6% contributing approximately 3.7 trillion US dollars. So by adopting fintech, financial revolution, technology revolution 4.0 as a subset of the industry revolution 4.0 will assuredly bring absolutely 3.7 trillion US dollars. You know by when? By 2025 itself. In less than 1 year. We just need to be ready to adopt technologies, blockchain, AI, deep data. Please make sure, big data. And I'm sure you're already on course for it, but I would like to highlight the need for it. And therefore, across sectors, banking, insurance, mortgage, forex, we need to have technology rapidly brought in. Most of these countries which have adopted are showing already clear signs of being encouraged by further investments and so on. So I won't take more of your time. Gift City is something which you've already spoken about. I understand there's also an interaction time. There's immense scope for financial markets in the growing years, in the years towards Viksit Bharat. India can be the leaders for the world in creating the financial hub we need, whether it's a global hub, whether it's a fintech-based global hub that we're creating in GIFT, whether the financial market headquarters for India, Mumbai, you have so much opportunity. It is for you to engage with both the regulator, for which Government of India is more inclined to say soft touch regulation, consultative regulation. Consult stakeholders before you frame something. But even after framing something, I would want the financial regulators, be it the RBI, be it SEBI or IBBI, all of them, even after consultation, if they frame some rules, they should be ready for further and further tweaking on the ground and on the inputs which come from people who are on the ground. So stakeholders' input will have to be constantly flowing. Nothing is etched in the rocks. It's not a stone-laid rule. Regulators will have to be proactively engaging with the stakeholders so that even after due consultation, regulations can further be tweaked for the sake of better compliance, for the sake of soft touch regulation, and not be firm about things so that functioning becomes easy. India requires a very developed financial market, be it equity, be it currency, be it bond. We need India to attract that kind of funds and manage them efficiently. And with your kind of performance, I'm only very hopeful that India will have the strength of absolutely robust performance from the markets, and therefore reaching Viksit Bharat by 2047 or well before it, and reaching the third largest economy in the next few years is absolutely, with your help, Prime Minister Modi's goal, and he shall achieve it. Thank you.